For years, investors have watched China steadily build its gold reserves. But that's no longer the biggest story. What is unfolding today goes far beyond simply accumulating precious metals. China is quietly putting together an entirely new financial framework, one that could eventually compete with the system that has controlled global gold and silver prices for decades. This isn't based on internet rumors or wild speculation. It's happening through coordinated efforts involving the Shanghai Gold Exchange, the Shanghai Futures Exchange, and the People's Bank of China. Together, they're creating an alternative marketplace designed to function outside COMEX, outside the London Bullion Market Association, and increasingly outside the US dollar itself. If you've been keeping an eye on silver lately, watching COMEX open interest, monitoring registered versus eligible inventories, or tracking warehouse movements, you've probably noticed that the market feels different. The numbers have been pointing toward a much larger shift that's slowly taking shape beneath the surface. Today, we're going to break down exactly what's happening, why China is investing so heavily in its own precious metals infrastructure, and why this could eventually reshape the way gold and silver are priced across the world. If these changes continue to unfold, they could affect everyone, from physical bullion owners to ETF investors and futures traders. So stay with me because this story connects far more pieces than most people realize. To understand where we're headed, let's first look at the bigger picture. Gold has been on an extraordinary run over the past couple of years. Throughout 2024 and continuing into 2025, prices repeatedly climbed to fresh highs as central banks increased their purchases. Geopolitical tensions intensified, and concerns over government debt continued to grow. Rather than focusing on a price that may change by the time you're watching this video, it's more important to recognize the overall direction. The long-term trend remains intact. Gold has consistently produced higher highs and higher lows on longer-term charts, signaling strength that goes well beyond a temporary rally. This isn't simply a short-lived spike. It's part of a broader structural move that has been developing for quite some time. Silver has also been advancing, although its journey has been much more volatile, which is nothing unusual for this market. The gold-to-silver ratio continues to attract attention because whenever silver begins gaining ground against gold over an extended period, it often suggests that industrial demand is combining with monetary demand. That combination has historically created some of silver's strongest bull markets. But here's something many investors overlook. The gold and silver prices you see quoted every day aren't determined primarily by physical buying and selling. Instead, they're largely established through futures trading on COMEX, where leveraged paper contracts dominate daily volume. That's the benchmark the global market watches. And China has clearly decided that relying on someone else's pricing system is no longer in its long-term strategic interest. Before we move further, it's worth understanding why COMEX carries so much influence in the first place. Many people hear the name regularly, but few realize just how much control this exchange has over global precious metals pricing. COMEX operates as part of CME Group and serves as one of the world's largest futures exchanges for gold, silver, copper, and other commodities. Major banks, hedge funds, mining companies, refiners, and institutional investors use it every day to trade standardized futures contracts. While the London Bullion Market Association dominates the over-the-counter bullion market, COMEX remains the primary public benchmark that investors worldwide reference when checking precious metals prices. And that's where the real story begins. The first thing many investors don't realize is that most COMEX contracts never result in actual metal changing hands. Physical delivery is the exception, not the rule. Estimates often show that somewhere between 95% and 99% of futures contracts are either closed before expiration, rolled into future months, or settled financially instead of ending with bars of gold or silver being delivered. That doesn't automatically mean there's something wrong with the system. Futures markets serve important purposes. Mining companies hedge future production. Manufacturers lock in raw material costs. Large institutions manage price risk. These markets provide liquidity that helps global trade function efficiently. However, there's another side to that story. When the overwhelming majority of trading takes place through paper contracts, the price of a physical asset can become heavily influenced by leveraged financial activity rather than immediate supply and demand for actual metal. Over the years, this has become one of the biggest criticisms of the current pricing system. Every Friday, the CFTC releases the Commitment of Traders Report, commonly known as the COT report. It consistently reveals that a relatively small number of large commercial participants hold substantial short positions within the COMEX silver market. Whether someone views those positions as legitimate hedging or believes they suppress prices is still widely debated, but one fact remains unchanged. A handful of major players can significantly influence the benchmark price referenced across the globe. And that is exactly where China's long-term strategy enters the picture. Most headlines over the last few years have focused on China's aggressive gold buying. Month after month, the People's Bank of China has continued adding to its official reserves, while many analysts believe actual purchases may be considerably higher than publicly reported. Those purchases certainly matter, but accumulating gold is only one part of a much larger plan. The real transformation is happening behind the scenes through infrastructure. China isn't simply stockpiling precious metals, it's creating an entirely separate ecosystem for pricing, trading, clearing, and delivering gold and silver. Instead of relying on the US dollar, this system operates primarily in yuan. Instead of focusing mainly on paper contracts, it places much greater emphasis on physical settlement. Instead of following Western trading hours, it centers around Asian markets. That difference is enormous. For years, critics argued that paper markets were determining prices for commodities that ultimately exist in physical form. China's approach attempts to reverse that relationship by giving actual metal deliveries a far more central role in price discovery. And this isn't some future project still sitting on a drawing board. Much of this framework is already operational. The Shanghai Gold Exchange, better known as the SGE, opened in 2002 under the supervision of the People's Bank of China. Since then, it has expanded steadily and has grown into the world's largest exchange when measured by physical gold deliveries. That's worth repeating. When you look at real bullion changing ownership, instead of paper contracts being traded, Shanghai already handles more physical gold than any other exchange globally. China didn't stop there. In 2014, the exchange introduced the Shanghai Gold Benchmark, a yuan-denominated pricing mechanism designed to provide an alternative reference price alongside London's traditional gold fix and COMEX settlement prices. Unlike futures markets where most positions never require delivery, this benchmark is built around actual physical transactions. China later expanded access even further through the Shanghai International Gold Exchange, allowing qualified foreign institutions to participate directly using yuan-based trading. This move wasn't designed solely for domestic investors. It opened the door for countries looking to diversify away from the dollar system, particularly many of China's major trading partners and several members of the expanding BRICS group. As participation has increased, withdrawal data from the Shanghai Gold Exchange has repeatedly surprised Western analysts. Many researchers view these withdrawals as one of the best indicators of physical gold demand inside China, and the numbers continue pointing toward exceptionally strong buying interest. The broader message has become increasingly clear. China isn't satisfied with being one of the world's largest consumers of precious metals. It wants to become one of the world's primary centers for determining how those metals are priced. And once we shift our attention from gold to silver, the picture becomes even more fascinating. The silver market tells an even more revealing story. While gold usually receives most of the attention, silver may actually provide the clearest evidence of the broader shift taking place. In China, silver futures trade on the Shanghai Futures Exchange, commonly known as the SHFE. Over the past several years, both trading activity and market participation have continued to expand, making the exchange increasingly important within the global precious metals landscape. One key difference separates SHFE from many Western markets. Its contracts are built around physical delivery. That distinction becomes especially important whenever prices in Shanghai begin trading above those quoted on COMEX. When silver consistently commands a premium in China compared with New York, the market is sending a powerful message. Physical demand is stronger than what paper pricing alone may be reflecting. These premiums have appeared repeatedly over the past year. While they don't remain elevated all the time, every reappearance encourages traders to move silver toward Asia, where buyers are willing to pay higher prices. This creates a simple arbitrage opportunity. Metal purchased in Western markets can often be sold into the higher-priced Chinese market, allowing traders to capture the difference. Over time, this process steadily shifts physical inventories eastward. If you've been watching COMEX warehouse reports, you've probably noticed why registered silver inventories receive so much attention. Every shipment leaving Western vaults reduces the amount of metal immediately available for delivery. While inventory levels naturally fluctuate, Persistent physical demand from Asia places ongoing pressure on available supplies. China isn't simply consuming silver because it manufactures enormous quantities of solar panels, electronics, electric vehicles, batteries, and advanced technology products. It is also positioning itself to gain greater influence over how silver is traded and ultimately priced across international markets. So why is all of this happening now? Several powerful trends are coming together at exactly the same time. The first is the growing concern surrounding the global financial system itself. When Russian central bank reserves were frozen by Western governments in 2022 following the invasion of Ukraine, central banks around the world took notice. Regardless of political viewpoints, the financial lesson was impossible to ignore. Assets held within another country's financial system could become inaccessible under certain circumstances. For China, which has historically maintained massive holdings of dollar-denominated assets, that event reinforced the importance of diversifying into assets held under its own control. Gold naturally became one of those assets. The second driver involves rising geopolitical and trade tensions. As trade disputes between China and the United States have intensified over recent years, Beijing has gained another reason to reduce dependence on foreign pricing systems. Building domestic exchanges for critical commodities gives China greater control over markets that are essential to its long-term economic strategy. Another important factor is the continued expansion of BRICS. As new countries join the group and discussions continue around alternative payment systems, China sees an opportunity to position the yuan as a larger part of international trade. Precious metals provide a logical starting point because they carry intrinsic value and are not tied to the creditworthiness of any single government. Resource security also plays a major role. China imports enormous quantities of raw materials every year. Relying on foreign exchanges operating under foreign regulations creates strategic vulnerabilities that Beijing has been attempting to reduce for years. Gold and silver are simply part of a much broader effort to increase domestic control over commodity pricing. But this story extends beyond precious metals. It also touches the future of the US dollar. For decades, commodities ranging from oil to industrial metals have largely been priced and settled in dollars. That arrangement creates constant international demand for the US currency and reinforces its position as the world's primary reserve currency. China's growing network of yuan-denominated commodity exchanges represents a gradual challenge to that structure. The message is straightforward. Gold and silver don't necessarily have to be priced in dollars forever. They can also be traded, settled, and physically delivered through exchanges operating under an entirely different financial framework. Does that mean the dollar is about to lose its global dominance? Not at all. The dollar remains deeply embedded in international finance, while the yuan still faces obstacles such as capital controls and limited convertibility. But China's objective has never appeared to be an overnight replacement. Instead, it has been steadily building an alternative system piece by piece, year after year, ensuring that when more countries decide to diversify, the infrastructure is already fully operational. And precious metals have become one of the first testing grounds for that long-term strategy. The next question becomes even more important. If more investors, central banks, and industrial buyers begin favoring markets centered on physical delivery rather than paper contracts, what could that eventually mean for COMEX and for the future direction of gold and silver prices?